When people talk about dividend stocks, the conversation often splits into two camps that rarely understand each other. One camp believes dividends are for retirees, for people who want income today and are willing to sacrifice growth tomorrow. The other camp chases pure growth, dismissing dividends as irrelevant or even inefficient. Both views miss a deeper truth. The best dividend stocks for long-term growth sit quietly in the middle, compounding wealth, not because they pay high dividends, but because they pay sustainable growing dividends backed by real business strength. Dividends themselves are not the goal. They are a signal that a company generates excess cash, that management is disciplined in capital allocation, and that the business model is resilient enough to return money to shareholders without starving future growth. Over long periods, these signals matter more than short-term earnings surprises. The companies that consistently grow dividends tend to be the same companies that survive cycles, adapt to change, and compound capital steadily, while others burn out chasing expansion at any cost. One of the most common mistakes investors make is confusing high dividend yield with good dividend investing. A high yield often reflects stress, not generosity. It may signal declining earnings, excessive leverage, or a business facing structural decline. Chasing yield turns dividend investing into a trap where income looks attractive until the dividend is cut and the stock price collapses alongside it. Long-term growth comes not from how much a company pays today, but from how reliably it can increase that payment over decades. The foundation of long-term dividend growth lies in business quality. Companies that dominate their niches, enjoy pricing power, and generate consistent free cash flow are best positioned to raise dividends year after year. These businesses do not need to choose between rewarding shareholders and investing in growth. They can do both. Dividend growth becomes a byproduct of competitive advantage, not a financial stunt designed to attract attention. Another critical element is payout discipline. The best dividend growth companies maintain payout ratios that leave room for reinvestment and error. They understand that dividends are commitments, not marketing tools. Raising dividends cautiously, even during good times, preserves flexibility during bad ones. This discipline is why dividend aristocrats and similar long-term payers tend to outperform over full cycles. They are managed for durability, not applause. Sector exposure also matters more than individual yields suggest. Dividend growth is often strongest in sectors where demand is steady, margins are defendable, and capital allocation is predictable. Consumer staples, healthcare, industrials, and certain technology businesses fit this profile better than highly cyclical or capital-hungry industries. That does not mean other sectors should be avoided, but it does mean expectations must be adjusted. Not every industry supports decades of uninterrupted dividend growth. One of the most underappreciated benefits of dividend growth investing is behavioral. Dividends create tangible progress. Even when markets stagnate, cash continues to flow. This reduces the temptation to trade panic or abandon a long-term plan. Reinvested dividends quietly accelerate compounding, especially during downturns, when reinvestment buys more shares at lower prices. Over time, this discipline often matters more than selecting the best stock. Valuation still matters. A great dividend stock purchased at an unreasonable price can deliver disappointing long-term returns. Investors sometimes assume that dividend-paying companies are automatically safer, leading them to ignore valuation entirely. This is a mistake. Dividend growth investing works best when patience is applied not only to holding, but also to buying. Paying a fair price for quality preserves the margin of safety that long-term compounding requires. It is also important to recognize that dividend growth is not linear. Even the best companies pause slow or adjust payouts during periods of stress. The goal is not perfection, but persistence. A temporary slowdown in dividend growth is not a failure if the underlying business remains strong. Investors who understand this avoid overreacting to short-term noise and stay focused on the long arc of compounding. Ultimately, the best dividend stocks for long-term growth are not defined by lists or rankings. They are defined by characteristics: durable cash flows, conservative balance sheets, disciplined management, and a demonstrated commitment to sharing success with shareholders. These qualities do not change quickly, which is why dividend growth investing rewards patience more reliably than prediction. As interest in income and stability rises across market cycles, the challenge is no longer finding companies that pay dividends, but identifying which dividends are likely to grow, survive stress, and meaningfully contribute to long-term wealth, because knowing what to look for matters far more than memorizing ticker symbols, and understanding how to evaluate dividend sustainability, growth potential, and risk is exactly where we need to go next. By examining how to evaluate dividend stocks for long-term growth with clarity rather than temptation, because the difference between compounding quietly and getting trapped lies in the questions you ask before you buy. The first and most important question is whether the dividend is supported by free cash flow, not accounting earnings. Earnings can be managed smoothed or distorted by one-time items. Free cash flow reveals whether the business truly generates excess cash after maintaining itself. A company that consistently covers its dividend with free cash flow while still reinvesting for growth is building dividends on solid ground rather than borrowing from the future. The second criterion is dividend growth history, not just dividend existence. A long record of steady increases tells you how management behaves under different conditions. It shows whether dividends are treated as a core responsibility or an optional expense. Companies that protect and grow dividends through recessions, inflation, and industry disruption demonstrate a mindset aligned with long-term shareholders. This history does not guarantee the future, but it strongly narrows the range of unpleasant surprises. Balance sheet strength is the third filter. Debt magnifies risk in dividend investing more than in growth investing. When cash flows, weak and highly leveraged companies are forced to choose between servicing debt and maintaining dividends, and dividends almost always lose. Strong dividend growth companies typically carry conservative leverage, ample liquidity, and manageable refinancing schedules. Financial resilience is what allows dividends to grow steadily instead of swinging with the cycle. The fourth consideration is return on invested capital. A company that earns high returns on the capital it reinvests can grow dividends without stretching itself. This is the ideal compounding engine. When returns on capital are weak, dividend growth often relies on financial engineering rather than economic strength. Over time, markets expose that weakness. Dividend growth fueled by genuine profitability lasts. Dividend growth fueled by balance sheet tricks does not. Valuation discipline must come next. Even the highest quality dividend grower can deliver poor long-term results if purchased at an excessive price. When valuation is stretched, future dividend growth is already priced in, leaving little room for error. Patient investors wait for moments of uncertainty, temporary disappointment, or broad market stress to initiate or add positions. Dividend growth investing rewards calm entry far more than constant activity. Sector balance also matters. Concentrating too heavily in traditional dividend sectors can create hidden risks, especially in changing rate or inflation environments. The strongest dividend growth portfolios often include companies that do not look like classic income stocks today, but have the capacity to become major dividend contributors tomorrow. Dividend growth is a trajectory, not a static label. Perhaps the most powerful discipline is reinvestment. Reinvested dividends quietly accelerate compounding, especially during periods when prices are depressed. This is where dividend growth investing reveals its long-term advantage. Income becomes ownership, ownership becomes more income, and the cycle reinforces itself without requiring prediction or timing. In the end, the best dividend stocks for long-term growth are not those shouting the loudest with yield, but those whispering consistency through decades of execution. They reward investors who think in years rather than quarters, who value resilience over excitement, and who understand that the most reliable wealth is built slowly, with cash flows that grow, survive stress, and compound patiently. If this discussion helped sharpen how you think about dividend growth, consider subscribing to stay with these long-form conversations focused on durability rather than hype, and leave a comment sharing whether you prioritize dividend growth yield or a balance of both, because that preference often reveals how you truly think about time, risk, and compounding.